works. Okay, so last time we were talking about the ad hoc ways how countries are trying to avoid financial crises or any, or not avoid, but at least manage crisis situations. So we were able to see that gold reserves, foreign exchange reserves are against the temporary suspension or even inevitability of market or private liquidity when we are not able to renew our external debt for some short time period. So in this case, central bank can step in and they can start to provide loans to the commercial banks, and after that commercial banks will do their job to allocate funds and in this case to provide funds to renew expiring debt. Also, we were able to see the new innovation from the 2008 when also some central banks, only in advanced economies, were allowed to participate in swap lines. So that was a really narrow part of the market, but at least we were able to participate. And after that, we can see the big institutionalized version of the financial contingency lines. So obviously we will start with the International Monetary Fund, so the IMF, because this was created right after the Second World War to mitigate crisis situations and also to help governments to balance out crisis situations. And since it was inadequate sometimes, or still we can see that in many cases IMF support can be insufficient. That's why many regional financial arrangements were created, which is a really stupid name, but I don't know why they will come up with this term, but practically these are regional funds organized in different ways, organized on different bases. Some of them are just providing swap agreements, some of them are providing loans, multilateral loans. So that's why it's quite ad hoc what we can find inside this arrangement. Some of them are just paper, some of them are actually working. So we will see, because they became really active during or after the COVID-19 pandemic, because in this case they had to provide additional liquidity. So in this case we can see that which one is working and which one is not working at all. Okay, so obviously we should start with some simple facts. So this is bachelor level knowledge, just to refresh. So deficit and debt, it's no problem if we have budget deficit, and it's no problem if we have public debt until, first of all, this public debt and also this deficit was created because we are investing into people, into the infrastructure. So somehow we are building up the economic basis of the economy that in the future or in the near future we will have higher tax revenues as a government. So that's why we are training people, because they are just, okay, they will not stupid in the future, but also they will be paying potentially higher taxes because they can work in higher value-added jobs, and that's why they can have higher wages, and after that all the value-added tax or the wage-related taxes will be higher because they are more better in terms of knowledge. Also, if you are thinking about corporate perspective, then long-term assets or long-term investments, like infrastructure, should be also financed from long-term liabilities, so debt. So in this case, it's much more adequate to use long-term debt because this will generate revenues in the future. So not just using actual year's revenues to do investments, because in this case we are not developing anything to anywhere. So So that's why the build-up of the debt is not a bad thing until, I don't want to say sustainable, but until we can see the rationality behind it. So there are programs, and these programs are moving towards one direction. It will generate higher economic activity sooner or later. And the other thing, what is relevant, that most of this debt should be financed domestically. So we should have enough domestic savings, households, banks, insurance companies, also pension funds should be there, should be available, and they have to be able to buy up most of this public debt. So we can use also external funding. Just in this case, we will also exposed towards external funding conditions, sentiments, what is happening with interest rates and other markets, what is happening with risk appetite and other markets. So in this case, we will expose towards the spillovers from different economies. Okay, so after these things, still we can say that, okay, state-owned enterprise, I don't want to go into this rabbit hole. So, crisis situations. So first of all, there can be domestic and there can be external factors. So domestic factors by the IMF usually the same three things. So first of all, state, so fiscal policy, monetary policy is reacting in an inappropriate way. So first of all, they don't have fiscal constraints. So deficit, budget deficit, and also public debt is increasing because of sometimes even fiscal alcoholism. It can happen that they are trying to stimulate the economy more and more, but at the end of the day, the tax base is not increasing or not growing at all, just the public debt or the deficit. And also, monetary policy can mess things up if they have a fixed exchange rate regime, and this fixed exchange rate regime is fixed at inappropriate levels, so practically they are just killing the foreign competitiveness of the export sector, and that's why the economic growth will decrease. And of course, political instability, weak institutions, so when the state itself is not working, and that's why. So in the case of a capture state, in all other cases, we can see that obviously this will be a really important domestic factor, that the economy is not growing and also the state is not performing well. External factors or external shocks can be absolutely various. So natural disaster, usually we cannot do much about this. That's why we have the state to mitigate the impacts of a natural disaster, because, okay, until one house is burning down, then insurance companies can do their job. But if a whole city is burning down, then insurance company would go immediately to default. So that's why we have the state, and that's why we have taxpayers' money and all this public debt to have this power to mitigate such level of disasters. Or also when harvest is poor, then this is traditionally a job of the state since the last several thousand years. Also, large swings in commodity prices. That's why we were able to see during the last weeks that many sovereign wealth funds were created in commodity-rich economies, since oil prices and also commodity prices are going up and down, so they are always following the sinus curve. Many of them are not just driven by supply and demand, but also they are driven by expectations about future demand. So future economic growth, practically, especially in the case of the oil. And in this case, for an oil exporter country or any country which is exposed towards commodities, commodity prices, it's much better to them to create reserves which are at some point can be transferred into sovereign wealth funds, and after that they can use it a buffer. Well, not just the annual tax revenues will be realized, but also if they need, then they can use up the capital allocated in the sovereign wealth fund. Also, sudden changes in market sentiment, as we can see it during the last, I don't know, 20, 30 years. So if we have globalization, it means that not just foreign trade is free, but also the free movement of capital is present at some levels, which means that external funding will be also present. And the problem is that governments are only like free capital flows until this capital is flowing in and financing their debt. But if they are somehow irritating the foreign investors, or the foreign investors are afraid, or they suffer losses from their businesses elsewhere, and that's why they are forced to sell or liquidate their investments, and that's why they are moving out, then governments can be really unhappy. But still, if you are participating in this game, then obviously you have to suffer the consequences. And that's why spillovers from other countries, this is also part of the modern, and not just the modern economy. If you are checking Bronze Age societies in the Asian and European and even African continent, because it was also integrated at that time, we can see that the same thing happens. So it doesn't matter that which age do we check. If we have any kind of a trade integration, then spillovers will happen. Yeah, so according to IMF, we can have three different kinds of crises. So one is related to balance of payments, one is related to the financial system, and one is related to fiscal policy. So obviously we can combine them in many cases. Also, local economic and political elites must work hand in hand for a decade at least to create a crisis. So crises are not just coming from thin air. Things have to go sideways for years until we are facing with one of them, until things get really serious. So also it can happen that we have a financial crisis, the government tries to mitigate this, which increases the public debt, and after that they will go to default, as it happened nearly happened in the Spanish case. So that's why we will have the ESM later on. Okay, in case of public default, we can see the following issues. So first of all, we are not able to sell government bonds at a reasonable price. So if yields are reaching a level, then maybe it's not reasonable to sell them anymore. Or it happened in 2008 that there was no demand for government bonds, so in this case the reasonable price was zero, or unreasonable price, because there was no offering in many cases. But also during the sovereign crisis in the Eurozone, we were able to see that, and also if you are checking the data, that yields were constantly increasing. So as market participants became more and more afraid what is happening there. And what is a really common misconception, that debt to GDP level doesn't matter. So countries can go to default even at 30% debt to GDP levels if domestic funding is insufficient, or if a population lost most of their savings before because of high inflation, because of nationalization of the assets, or something like this happened in the past, and they are discouraged to keep their savings at home, which is terrible news, because in this case they will send their savings abroad. Then after that, the financial sector should take up a loan abroad. Maybe they have to take up the same amount of money abroad, but still they have to go around. And in this case, obviously, interest rates will be higher, and also they can get foreign exchange exposure as well. So capital flight can be a really tricky problem. So we have to avoid it. So debt to GDP level, yeah, they are nice indicators, but what is much more reasonable is to check always the yield levels, because they can tell us way much more. Okay, but if we cannot sell at a reasonable price, which means that because there is no demand or the prices will be really poor, it means that we are not able to renew our debt, or we are not able to renew this debt at the same level. So sooner or later, because we can sell it at cheaper and cheaper prices, I mean the new bonds, then the level of public debt will increase because of this. This is what happened in Hungary during the 70s and 80s under the communist regime, and that's why we have way higher public debt even today because of this. Oh, so what can we do? First of all, we can ask for creditors to do debt rescheduling, which means that once the government bond expires, then we are paying them not with cash, but with another government bond. Or practically we are just elongating the maturity. This is still better because at least much better, because in this case interests are paid. So there are no losses at the level of the asset side in the banks and insurance companies and pension funds and so on, who are our natural investors. They will be a bit unhappy, but from liquidity point of view and from accounting point of view, it's still okay. What is not okay is debt reduction and forgiveness. So in this case, sometimes, also in case of companies, what we can see, what happens in the case of a corporate default, that in many cases they are reducing the value of existing equity, so shares will lose their value, and usually they are transforming half of the, or you can convert your bonds at a 50% ratio to equity. So practically you will be the new shareholder. Usually this is the recipe for successful bankruptcy consolidations. In case of a state, we cannot do this because we don't have shareholders, luckily. Or we, the citizens, could be, but okay, I don't want to go into this direction. But in this case, debt forgiveness requires someone as a creditor to say that, okay, we don't create any problem about this one, because if you are just indebted against a bank, then you can negotiate. But if you were issuing government bonds in the past, it means that you have infinite amount of creditors. So this is never a small set of creditors if we are funding ourselves through bonds. And if only one of these creditors will say that I don't want to accept these rules, then you can go to court for the decade. So this happened with Argentina during the previous decade. So during the 2010s, that one hedge fund, US hedge fund, was not accepting the terms, and in this case the whole procedure stopped. So in many cases, debt forgiveness programs are happening the following way, that the IMF or some regional financial agency will buy up the government bonds from the private creditors, and after that from sovereign funds they are doing the bailout, or practically in this case the debt forgiveness, and cut it back. Okay, so in this case where we are doing the negotiations, so Paris Club is the sovereign lenders location, and the London Club is for the private lenders. But again, most of the successful debt reduction programs were happening in case of the involvement of Paris Club and the IMF. So yeah. Yep. as I mentioned, we can combine sometimes things together. So bank crisis can lead easily to public default because the size or the balance sheet size or the number of or value of total assets can be at the same level of the national GDP. So in many cases, countries are redistributing the annual half of the annual GDP, or at least 40% of the annual GDP, which means that this is the level of their revenues. And in this case, you cannot use all this money up to support the banks. So obviously, you have to issue government bonds. And if the market is already in troubles, so there is insufficient liquidity, then you are not able to sell enough government bonds. So consolidating banking system by debt issuance, it can be a problem. So that's why in many cases they are trying to do it through mergers. So they are taking a good bank and forcefully merging it with the bad bank. And in this case, we have some kind of a mediocre bank with still good enough capital adequacy. Yeah. Okay, contagion. So this is my favorite topic because it means that how things are spreading from country to country, and there are many different definitions. What I prefer is the very restrictive one. So in this case, we can see that markets tend to have higher correlation under stress. So this is the strict definition of contagion. So it means that correlation increases dramatically. So in case of stock markets, we can see it always that in specific industries, doesn't matter that, for example, a bank is using subprime approaches to fund themselves, or are they using securitization or whatever, so some fancy derivative, are they using it or not? If investors are afraid of banks, then the whole industry will be affected. And again, if we are checking the stock market indices, this is what we can see, that if there are bad news, the whole thing, the whole market network will synchronize. And in this case, they will start to fall at not at the same rate, but at least they will be highly correlated. Otherwise, they are not so correlated. So once things, so until stock market indices and prices are going up, then this correlation is really poor. But in this case, it will go upwards. The funny thing is that at the bond market and currency markets, things are going backwards. So in currency markets, all the regional currencies have a really high correlation with euro. So even if you are not part of the Eurozone, currencies have 0.7, 0.8, sometimes 0.9 correlations with the euro as a currency. And when there is a shock is happening, then this correlation drops temporarily. So correlation between financial assets are always time variant, so they are changing in time, but this is a broadly observed phenomenon. In the case of bonds, short-term bonds have absolutely no contagious effects. Long-term bonds, this is what we can see as well, that at least yields have a tendency to increase altogether. If we can define the set of problemless economies. Okay. And impact of crisis, slow growth, increasing unemployment, lower incomes, uncertainties, deep recessions, and so on. So, sad things. Now let's see IMF. So, first of all, in many cases, unfortunately, even in the literature, IMF is always described as Superman. That's, oh, there is the crisis, and Superman arrives, and the crisis is over. So, obviously, they are not Thanos, they are not Superman, they are just a bunch of economists. So, we can find there 3,000, less than 3,000 economists who are trying to mitigate problems, and they are trying to manage crisis situations. So what was messed up by millions of people for a decade, they cannot solve it overnight. So this is always a misconception about IMF when people are looking for some redemption by it. So, what are the general obligations of the members? So first of all, restrictions on current payments. So it's not nice if you are accepting happily the investments from abroad, and when it would like to go home, then you are saying no. So you cannot use your no card in this game. So current payments, once they are liberalized, then they should be stayed as liberalized. Also, discriminatory currency practices, they are not nice. So not cheating with the foreign exchange regime, please. Convertibility of foreign held balances. Convertibility, in this case, it means that, again, the free movement of capital is present. Since we don't have currency, since we don't have gold behind our currency, luckily nowadays, then that's why this convertibility term was rephrased as free movement of capital. Furnishing information, so it's a nice thing if you are not cheating with your statistical data about public debt, deficit, and so on. So that's why they try to harmonize all the fiscal statistics. And obviously governments are still trying to cheat with this one, just at least they are trying to catch up. And also this information is also publicly available, so that's why we have fancy databases, because they were not available during the 90s, and then the IMF realized that maybe it's much better if you are providing information for the investors officially. Also, consultation between members. So even if you are not the subject of any IMF loan, still twice in a year, people are coming from the IMF to the National Bank and to the Ministry of Finance just to talk. Also, they are writing their reports. They are defining or describing the country's imbalances. They are also assessing the economic conditions. So if you are interested in any country, then I can recommend these annual reports about the member states, because for each country you can get this, and after that, if you are working for a company and you have to assess country risk, then this can be a key ingredient, because these reports are really good. And obviously these documents will be the basis of the contract in the future if the country needs any kind of funding from the IMF. And of course, obligation to collaborate regarding policies on reserve assets. So practically they are collecting funds from member states and after that distributing as loans if countries are needing this one. So Article 8 is always referred, but practically we can see all the rules and regulations here. Yeah. Okay, I mentioned it. Also, I mentioned convertibility. So let's see. So first of all, this is a non-profit bank. Later on, we will see there is only one for-profit bank, which is listed on the stock market and pays dividends, but that one is the Bank of International Settlements, so the BIS, because it was created after the First World War, and that one is a special entity. All the post-Second World War banks and financial institutions were created as non-profits, so which means that they are not paying dividend for their parent nations, and so they are just reinvesting into themselves, and also they are not profit-oriented in terms of their operations. Still, they like money, and still they don't want to lose capital, but otherwise, yeah. And also, they are owned practically by the United Nations. Otherwise, they have equity, and if you would like to participate or take part or be a part of the IMF, you have to pay in some capital, but 25% of the equity is only paid in equity. So the remaining 25% is non-paid. It's only required, or it should be paid upon request. So if they would suffer some losses on their lending operations, then if they are burning through this 25% of paid-in capital, then they could require it, but nobody did this. So, yeah. Also, what we can see here, depositors, since this is a bank, so we should have deposits, not just equity, countries. And mostly central banks are allocating some part of their foreign exchange reserve to the IMF because yes, we can say that okay, we can buy German or US government bonds as a foreign exchange reserve, or we can also provide loan for the IMF. And also, obviously, loans are provided to the countries. Again, with this remark, or that if market-based funding would be inappropriate. And how they are operating, all their operations are running around the quota. So quota determines the voting power of each member state. Quota determines the contribution, so the level of the deposit, and also quota determines the access to loans. So voting power, how much money you should add in, and also how much money you can take out, and also they have their own, I can't say currency, it's much more like an accounting unit because we cannot buy SDR in the banks, there is no paper money printed as SDR, it's a basket currency, like it was the European currency unit. So there is a ratio of different currencies, and in the specific order, if you are mixing them, then you can create your own SDR at home. It has a really stupid name again, so special drawing rights. It has nothing to do with drawing, it has nothing to do with rights. It is special, at least. I don't know, they could call it also potato, but somehow people at marketing department was coming up with fancy names. Originally, they wanted to create paper money, paper gold. So the first concept in the 60s or in the 50s was that it will be much more like as a current cryptocurrency because they can extend the amount of gold in deposits by this thingy. But after that, it was completely abandoned, so only the name remained. Okay, so we were able to see the objective already, so let's move towards the quota because this is much more interesting. And I also spent a lot of time to create this Excel table here. So first of all, the quota depends on the following composition. This is also one favorite question at the exam, that how can we determine the quota. So obviously we have to, first of all, we have to consider the size of the country. So how much money can they pay us and how much money we need from us. So that's why half of the quota will be determined by the GDP. In this case, they are using purchasing power, level of GDP, and combining with other ways. Doesn't matter. So GDP, economic size. Other thing, economic openness. Obviously, more open economies can require more funding. And also they have much more importance from the world economy, so that's why we have to take care more of them. So export plus import divided by GDP, it will determine the openness, and after that we can see that 30%. Also, economic viability is another thing. So if the whole GDP is dependent on one sector or two sectors, then they can be much more exposed. So that's why their quota will be smaller. And if the economy is much more diverse, then they can be much more robust. So we have higher chance that we can provide or they will less reliant on loans from the IMF, and they can provide much more money. And also, which is quite strange, that only 5% of the reserves, but this is what we can see here. And also what we can see that if we are summing this up, then the end result will be not 100%. So obviously they are trying to follow this, but also they added an asterisk that there is a balancing thingy which creates additional constraints. So what happens in real life that many emerging economies were increasing their quotas because quotas were renegotiated during the 90s, during the 2000s, during the 2010s. So right now we are using the current structure, and also sometimes quota and voting power can be a bit different from each other. So if you are checking the website of the IMF, we can see a bit different quotas and a bit different voting percentages, but okay, they are quite close to each other. So they are still playing with statistics, so not just this exact composition, what we can see there. But if we are checking countries, it's always funny that if you are asking people on the street, they will say that, oh, IMF is an American entity, and it always represents American interests. Yes, but the head of the IMF is always someone from Europe. Also, if you are checking quotas, then EU or even Eurozone has higher quotas than the United States. So it's a good thing because they are hating the US for the mishaps of the IMF, which is much more like a European thingy than an American. If you are checking also other countries, so BRICS has also quite a reasonable size of quota, but mostly it's coming from the Chinese quota, which is half of the BRICS, or more than half of the BRICS quota. If you are checking also the UK, in the past the EU quota was bigger because they were in, now they are out. But also if we are checking other economies, we can see that, okay, they have high percentages. Unfortunately, this table is not downloadable, so there is no Excel sheet on the website of the IMF, so manually I have to collect it today when I wanted to see. And also if you are adding advanced economies all together, they are around 60%. So there was an argument even during the 90s that developing economies are underrepresented in the IMF. And that's why quotas were also renegotiated, because many developing economies or emerging economies started to provide loans to the IMF, so that's why they require that they should be represented much better in terms of their quota. Okay, SDR. As a basket currency, we can see that, as I mentioned, we can make our own SDR at home, so we just have to collect the following currencies. So a lot of US dollars, some euros, some Chinese renminbis, some Japanese yens, and some British pounds should be added all together, mixing them up, and after that we'll be the happy owners of our artificial SDR at home. Also the interest rates are following the same procedure, and after that SDR is used for lending, depositing, accounting units of the IMF. The reason was that until the collapse of Bretton Woods, US dollar was completely fine, but obviously after that it was not so fine, because if a free floating currency is changing back and forth, and the whole financial safety network stability depends on this fluctuation, and also not just the US is providing funds to the IMF, but also many other countries, and also many emerging economies are providing funds for the IMF. That's why it was much more welcome to use this tested currency. Yeah. Okay, if you are checking IMF loans, so we are talking about the banks, and obviously this bank should provide loans to someone. And so IMF has terrible phrases. So it is a bank, but they are using, or they invented their own phrases for everything, which is really stupid. So concessional loans or lending means that they are providing loans at a reasonably low interest rates because the country is already in trouble. So let's not do this. The non-concessional arrangement means that they are providing much more like market-based lending, just they are providing as a secure lender. So you are not exposed towards the market sentiment, but you are getting the money from the IMF. Also, the outright loans, they are not require any kind of structural change. They will not monitor your economy closely. They are just providing you funds to practically in this case, they are not providing funds to stabilize the economy because this money is allocated to stable economies. They would like to avoid the spread of a crisis. So when Romania and Hungary was nearly defaulting in 2008 and 2009, and then we had to go to the IMF for funding in autumn and in spring, then Poland was getting an outright loan, but they never used this capital. So they had the option that, okay, if you are facing trouble, and also the same thing happened with Mexico and also with Colombia, if I remember well, but we will see it later. So they had the option that, okay, if in the near future you are facing with trouble, then you can use this money up to repay your expiring external debt. So practically, in case of Poland, they had this contract alive, or kept this contract alive until the late 2010s. Maybe they ended it in 2018 or 19, so somewhere before COVID. Until then, they were just saying that, okay, the money is on the table. If we are just signing the contract that if we need this money, then we can take this money off the table. But obviously, this outright loan is much more like an option, not a real debt until you are not initializing it. Yeah. And after that, let's see the huge mess of structuring loans. So this is, you don't have to learn all these things or most of this. So what you have to remember at exams that, okay, there are these general resources accounts, there are this poverty reduction and growth trust, there is this resilience and sustainability trust, but after that, at which loan is, at which maturity and so on, I just would like to talk about today, but nobody should remember this. You can get it on the internet. So, what I would like to show you is much more like that, how they are thinking about economy. So, first of all, there is the general bracket of countries. So, in this case, quotas. 100% of the quotas, 200% of the quotas, 300% of the quotas. You can use this kind of a fund if you are an ordinary, simple economy. Poverty reduction and growth trust, they are only for low-income countries because obviously they need special care. So you cannot just ask any or as much interest rates or things like this as possible, and also you should support them by much more institutional support. So not just give the money and goodbye, but also they need much better supervision. Or at least this is the concept. So in case of the ordinary or general loan, there is the standby agreement. We can see here that, yeah, these are for at most 3 years. So they are relatively short-term lending, at least compared what we can see later on in other type of loans. Also, so usually, at least according to my experience, so now I survived many different global crisis situations since the 2001. So usually the intense part of a crisis happens or ends at least within 3 or 4 months. So this is where we have severe liquidity scarcity or no liquidity at all, or when you are not able to sell government bonds, when the stock markets are collapsing. So within 3 or 4 months, things are over. So we are reaching rock bottom. So in this case, for the IMF, this 3 years is absolutely sufficient and enough. Usually, IMF arrives at least in 2008. So, for example, Hungarian bond markets stopped to exist in October, once Lehman Brothers collapsed in the US, and in November we already had the contract. Until this point, obviously, you have to survive from your own foreign exchange reserves, but yeah, so sooner or later cavalry arrives, and after that they can start consolidation, and within 3 years, at least you should do something to calm markets, to do something to become attractive again. And also what we can see here that after 5 years you have to repay everything. Also the interest rate is defined with a minimum level, with margin, with some additional surcharges with the level. So if we are above so if we are big lenders or debtors, then obviously they will ask for some surcharge, and also if we are taking up a long-term loan, then it will be punished, but it's like any kind of a loan. If we are going further, then we can see that there is this extended funding facility. So when things were not that simple to consolidate, so it's not just some shock happened in the US markets and after that we were hit hard, but also we had structural issues. In this case, we have to work much more. So our wise politicians were not that wise, and they have to monitor carefully, and that's why. So I always prefer this structural reforms or structural problems when a lot of things are messed up and tangled together. This is when we are talking about structural problems. That not just we have to increase or decrease one tax or increase one tax or reduce one expenditure, but the whole fiscal policy is a mess, then obviously we have to have some structural changes at the level of institutions, at the level of governments, at the level of many things altogether, which takes time, a lot of time. So this is what we can see here, that it can be a 10-year long project until we can completely go back to market-based funding. Rapid financing instrument is different. In this case, they can give you immediately the money, so just instantaneously you can get the funding. And if you have a large natural disaster, this is usually the case when you can get some kind of loan like this. But again, this is quite relatively short term. Yeah. Flexible credit line. This is again a short-term thing when you have liquidity shocks. And then there is a short-term liquidity line, which is again for 1 year. And this is the precautionary and liquidity line, what I mentioned in the case of the Polish case, okay, we have the option to take up a loan from the IMF, but mostly they are just keeping it on the table. At least what we were able to see until today. Nobody used this one yet. Yeah. In the case of the Resilience and Sustainability Trust, which is absolutely a new thing, so it was created before the COVID or during the COVID, we can see that this is also relatively short term. But what we can see here that, I mean, you can get the money for short time period, but after that, this will be repaid after really long time, and also at a really low interest rate. So we can say that in this case it's much more like funding long-term projects, not the usual survival game, what is happening from IMF funding. So if you are looking on the different procedures, we can see that, yes, poverty reduction is important, but mostly it's about bailing out different economies when troubles are hitting them. So I remember that in 2006, you were able to find really optimistic reports by the IMF that, oh, more work is not needed nowadays so much, and after that until it didn't. So we have to come back to business. But once the worst part of the crisis was over and economies were able to go back to finding themselves through bond issuance, then it was decreasing again, then it was increasing way before COVID. But COVID was peaking it, and then it's decreasing again. So I will show you that some countries are regular guests. So they are too fragile. My colleague Sabri collected all this data from the COVID time period. We had a paper which was partially published, but after editing, so many things were disappearing. I think also these parts were edited out by the editor because the paper was too long. So in this case, you can see that mostly the rapid financing instrument was highly popular according to the different countries. Some of them still were using the old-fashioned standby agreement, but otherwise in different regions, different countries used different channels. And this is the market-based, this is the non-market-based facilities. Also, we have the same thing with colors. Now let's talk about who are the main lenders. So mostly what we can see here that paid-in quotas are the most relevant funds. So we can see that they are deposits. Multilateral borrowing, when countries individually, we can see that, oh, I would like to give you money or not. They should still participate in the program. They will be selected, but otherwise they are providing funds in SDR. And this is the bilateral borrowing. In this case, you are providing funds in your domestic currency, or you can pick which currency you would like to use to fund the IMF. So they are much more customized than the other ways. And if you are checking the most recent data from today's website, so still now 1.5 years ago, we can see that, okay, this is the lending capacity. So right now, this amount of money can be lent out. So the difference is what is right now lent out and on the market, and this is available for countries if they are facing problems. Yeah. And okay, I created a graph where you can see that in case of the net arrangements to borrow, so in one of these programs, who are the main creditors, so we can see here Japan provided a lot of money, US provided also a lot of money, China also provided a lot of money, and then Germany, France, UK, Italy, Saudi Arabia, the Swiss National Bank, and so on. So all these countries were providing some funds, and during 2009, even the Czech Republic was providing funds. Just it expired, and after that they did not renew it. So even Czechia was appearing at the depositor side, not at the subject of lending. So altogether, if we are thinking about the concept of debt financing, public debt financing, then we can see here the state, the private sector, banking system, foreign investors. So if we are slicing up the cake of the government bonds, then we can see that some part of this cake will be in the hand of households, some part of this cake will be held by the banking system because they have to keep mandatorily some of their assets in government bonds, so they have no other choice, and also they have to diversify lending risk. And also some of them will be landing in the hand of foreign investors. So what happens in the case of an IMF loan is that some of this we cannot renew. So this expires and we have to do something with that one because foreign investors right now, they don't want to buy this. Maybe also domestic ones, but let's blame only for the foreign investors. They are not buying it. So in this case, we need someone. The easiest solution would be that let's go to another. So if you are not able to use market-based funding, then let's go to another government. Just obviously in this case you have to negotiate with the other government to have a bilateral loan. What are the terms? Also in this case, this other government have to issue government bonds and then give this capital to us. And after that, they will be really anxious because they are not sure that how this money can be repaid or will be repaid. And also they have to sell this great idea to their own taxpayers, voters, opposition parties in the parliament. Also, we can do it at multilateral scale when a set of governments will stand together and provide loans, but these are always terrible and troublesome. So you can do it maybe once, twice, but governments are even terrible to manage their own things, not just manage other countries' things. So that's why IMF is much better because they are professionals. So this is their job, to provide conditional lending to countries and also set the requirements and monitor the repayment and the changes of conditions. Which means that in this case, IMF have to take up loan from the governments, and in this case, their governments sooner or later they will sell also government bonds to foreign investors. So at the end of the day, if you are not buying, let's say, government bonds from Argentina, but you would like to buy US government bonds, then the IMF as a middleman will use this excessive US government bonds to channel in, and then they are providing these funds to Argentina. So this is the business model, what we can see here. And how does it work? So let's give some optimistic example. So what happened in the Central and Eastern and Southern Europe? So practically in this Europe, which is mostly nowadays considered as part of the European Union, during the transition times. So, because in this case, what we can see here, for example, in case of Poland, they had debt scheduling and also debt forgiveness. Because Poland was absolutely in trouble. So they had even a military junta since 1982, because the Communist Party was so terrible in Poland that there were strikes, riots, and many other things. So the Soviets asked the Polish military to introduce martial law and to avoid these things, or make these things manageable. But practically the economy was already in ruins in the 80s. So until we are reaching the 90s, it was even more terrible. So in case of Poland, most of their external public debt was coming from West German state-owned banks. So in this case, it was way easier to negotiate because a small set of banks were all of their debtors or creditors, and also they were state-owned, so state German government was able to step in to improve the negotiations. Since we were also the member state of the IMF since 1982, Hungarian governments wanted to do this earlier, just the Soviets did not want it to support it, but we were so close to the public before that, okay, we were allowed to do that. So from we had to take up a loan from China, or from mainland China, even to pay in the required entrance fee to the IMF, so practically equity and also the quota money. And so at this point, we were just getting a newer loan, and also the IMF tried to do the reforms. So practically, they were also responsible for the transition from the hot mess toward the market-based economy. So that's why what we can, even today, we can see that many of Hungarian business-related laws are based on German legislation. So if you are comparing laws about banking or insurance or competition or any other things, they are not literally translated, but many concepts are coming from Germany. Also, Czechoslovakia joined the IMF, also Bulgaria joined the IMF, and also after that we can see that, yeah, money is arriving in the next year to Hungary, Bulgaria, Romania, Poland, and also in Bulgaria there was also a serious debt rescheduling. Next year we can see that even Czechoslovakia got once some SDR, so this is the only case when they needed funds, so they are the most developed economy in the region, so but for reconstruction, they still needed some funds. Also, finally, Soviet Union collapsed, so Lithuania, Latvia, Estonia became independent and joined the IMF immediately. And also, we can see that Slovenia also succeeded from Yugoslavia and also joined the IMF as a member. And after that, still we can see during the next year that, okay, now we have separated Slovakia and Czech Republic, but still they needed IMF membership. But again, money is flowing in to the region because most of this, so Hungary was able to issue government bonds, but only with 1 or 2 year long maturity. So only short-term government bonds were sold on the market. So otherwise, IMF was providing funding. Also, at these times, many or most of these economies lost at least 1/3, sometimes even half of their GDPs. Because some of the state-owned or previously state-owned enterprises were absolutely not healthy, or they were never healthy. So already during the 70s, there were many state-owned enterprises which were losing money, and they had to be compensated from other profitable state-owned enterprises' profits. And once this thing disappeared, also some of these losses were managerial level, some of them were losses because there was insufficient funding available at this market, so really high interest rates, really narrow ways to take up loans. Also, people are saying that former Soviet markets collapsed, but mostly Soviet Union was not paying anything before of that for the excessive export or the export surplus or trade surplus what the regional countries had, so it doesn't matter. We can see that Bulgaria had a debt reduction agreement, again 50%. Also, in case of Poland, there was another debt reduction and rescheduling agreement. So we can see that London Club here and there, but they were state-owned German banks at the end of the day. So they were not funded through bond issuance. And after that, we can see that during the mid of the decade, then these countries were able to adopt or introduce the free movement of capital. So most of the capital restrictions were eased 5 years later. And also we can see that the list of the countries which will narrow down sooner or later. So still we can see the small Baltic economies, also Hungary and also Bulgaria and Romania will be among the fragile economies. But as time progresses, we can see that they can rely much more and more on market-based funding. So So already in the late 90s, some of these economies were became part of the NATO. They had also really good negotiations to join the European Union. And at this year, most of the countries were joining the European Union except Romania and Bulgaria because they joined only in 2007. So we can see that that was quite an efficient and also successful consolidation period, because mostly what we remember from the 90s that the IMF mismanaged the East Asian crisis and the Russian. I can't say that they mismanaged the Russian crisis, but also they mismanaged some crisis situations in Latin America. But in the case of the region, at least we can see that they did something well. And now they were really happy that, now we don't have to care about these countries anymore. And then 2008 crisis arrived, so Hungary, Latvia, Romania went back to the game, went back to the table that we need some funding. And also they provided this flexible credit line for Poland, which was never used later on. And now let's talk about regional financial arrangements. So I processed some papers for you. Practically, the motivation behind regional financial arrangements is that they need some kind of short-term liquidity provision. So if suddenly you are not able to renew your expiring external debt, then you need some ways, some forms, and sometimes it's easier to use locally sourced funds. So you should not go immediately to the IMF because they will require many things from you to stabilize your economy and do structural changes. In this case, you can just get the money, no questions asked. So why regional? Because in every region we can find some richer economies and some poorer economies, but even rich economies need their markets desperately. So for them it's also highly important to have stable background. And also IMF has its own limitation by its capital, by human resources. So in this case, we have exact numbers that at that time they had 2,400 people. You don't have to remember it on the exam. Just we can see that obviously they cannot solve everything on the world. They can manage things. Risk of the RFAs, obviously they have, so their institutional background is not that stable. Also, they have really limited ways what they can do if money is not repaid. So if you are not repaying money willingly to the IMF without any acceptance, then you will have to face with the anger of everybody else on the planet. So you were able to see that, okay, who are the biggest owner of the different quotas and also who are the other creditors of the IMF. In case of the RFA, we will see that also different regional partnerships can be problems if you are not repaying anything. Yes. There are nice stories, just I would like to go forward. So what are these RFAs? So right now what we can see here that if you are looking on the internet, we can find Arab Monetary Fund, Latin American Reserve Fund, North America Framework Arrangement. I don't know which one is this. Balance of Payments Assistance Facility, beautiful name. And also I would like to talk about ESM because I have much more data about, most of the data is available about this one, the rest is not so available. Also we have the Chiang Mai Initiative, and also the Eurasian Economic Community. So if we are going through all of them, we can see that, for example, Arab Monetary Fund, this is quite old, so this is nothing new here. Also, we can find not much money. So in case of capital, this is not a lot of capital, but at least this is available. So, but also we can see that this is really conservative. So this is amount of capital, and the provided loans are way lower than the capital. So this is not even one-to-one coverness. This is two-to-one cover. Yeah, and also they are providing relatively long-term loans. Also, what we have in Latin America, this is also, this was created during the 90s. Unfortunately, if we are reading about the crisis in Mexico, in Brazil, or in Argentina, this reserve fund, or at least the name of this reserve fund, is never coming up. Or at least I was not careful enough in this case, but yeah. So they can provide some loans for until 3 years, and also they are relatively conservative in terms of loan to paid-in capital ratios. This was created to the NAFTA, the North American Free Trade Agreement, and also to deal with the Mexican crisis. So in this case, they provided currency swap agreements to Mexico, and money was coming from Canada and US. And as you can see, this is not a long-term commitment. So this is much more like a swap, simple swap line. Obviously, if something has a really stupid name, then it can be related to the EU. And what we can see here, that yes, balance of payments. To be honest, never heard about it until I was compiling this paper. But yes, EU has something like this. And after that, they tried to introduce this one. This was also not so well made. So at the end of the day, all these things was put together into the European Stability Mechanism. So yeah, this one is well known and operational. Obviously, they had different attempts here and there until they were reaching this point, but I will talk about it later on. Okay, we have also something which is operated or supervised mostly by Russia, but with Armenia, Belarus, Kazakhstan, Kyrgyzstan, and Tajikistan. But this is just a treaty, so there is no legal entity based on this one. There is a Eurasian Development Bank which manages the resources, but mostly this is just a pool of reserves. And again, I did not hear much about this. Later we will have a table which shows us that what happens here. In this case, in the Chiang Mai initiative, we can see a lot of East Asian economies with Japan, China, South Korea, and so on. And it's again bilateral swap agreement network, and after that it was developed after the subprime crisis to make more lending decisions. But yeah, so also they are absolutely conservative in terms of lending. Okay, and after that, if you are interested what happened here and there, then there is this list from 2021 that who was allocating what. And in this case, we can see that until 2021, not much thing happened in the case of the Chiang Mai, so nothing was allocated. Then there was this US or NAFTA-based thing, it was also not used. Only the Eurasian Fund was used to provide funds for Kyrgyzstan and some for Tajikistan. Arab Monetary Fund was much more active, so in this case we can see funds to Egypt, Morocco, Tunisia, Jordan, and Sudan, so at least there was some kind of a lending operation. In the case of the Latin American Reserve Fund, we can see some possible money to Ecuador because at that time it was under approval. Then there is this other agency which provides at least swap agreements to Maldives and to Sri Lanka. So we can see not much, but at least some kind of operations, or sometimes zero. Yeah. Okay, so let's see ESM, because this is the... So at the beginning of the 2008 crisis, or after the intense part, when governments realized that if you are not doing anything, Greece, Ireland, Portugal, Spain, and Cyprus will default, at the beginning they tried to do or organize multilateral loans. They did it twice, and it was a disaster. I mean, they were able to allocate and collect the money, but it was a political disaster because, again, they had to do the negotiations. It was taking weeks, months, and also these governments are not professional lenders. So also they were thinking that the whole Eurozone should issue government bonds altogether, so that was called as Eurobond. But in this case, how can you allocate the quotas, how much public debt can you issue? So it was also a political nightmare, so everybody was running away from this idea. So at the end of the day, they created this monstrosity, and it's still not IMF. There were ideas that they should create a European IMF, which is stupid because, come on, 1/3 of the money is already coming from to the IMF from these countries. So it's again a nightmare, but something was necessary, so some kind of funds were necessary to the EU and to the Eurozone to stabilize itself, so they created ESM. And in this case, this is tricky because at least IMF has some kind of a paid-in capital, so only, as I mentioned earlier, 1/4, so 25% of the capital is paid-in capital. In the ESM, 0. So you have the lending capacity, so the option to issue bonds, sovereign bonds, until the limitation of 500 billion euros. And if these bonds are not repaid, then in this case, member states can pay or cover losses until 80 billion euros. But this is wrong, this is not paid in capital. This is absolutely an option. So nobody paid in anything to the ESM until today. So this is a highly leveraged position. It's not a conservative thing, but we were able to see in other cases. During COVID, they increased or doubled this, so they created the second 500 billion euro facility. But in this case, everything was rechanneled to infrastructure and other developments. So that's a completely different potato, so that's why I brought it into the presentation. So in this case, okay, the ESM is allowed to issue these sovereign bonds, and some part of the sovereign bonds is backed by, trust me, I will repay you sayings. But on the other hand, they have full degree of freedom, so they can issue really short-term bonds, and they can sell even really long-term bonds. Why? Because mostly they were providing really long-term loans as well. So the maturity was varying between 25 years to even 50-year long lending. So obviously, if you are not able to stabilize a country within 50 years, then why to have this country at the end of the day? So, so in this case, they were trying to pair also the liability structure of this debt with the structure of the loans. And otherwise, this institute is not intelligent. So IMF comes up with their own term. Okay, the member states should accept this by voting, but at the end of the day, they are autonomous. The ESM is not. So all the negotiations, all the conditions are made by the European Commission. So they are just the piggy bank to provide the funds, collect the funds, and after that allocate the funds. But they are not doing any kind of a negotiation. Also, they are considered as sovereign bonds. So which means that banks, if they are buying these bonds, then they don't have to make any regulatory capital reserve, and also they have AAA rating artificially. And after that, what matters that they are not running any kind of an interest rate risk. So if they are issuing the bonds are variable interest bearing bonds, and then the same interest will be provided or requested from the country which is targeted by the loan. So in this case, they are not running any kind of an interest rate risk. Only for Greece, they were issuing fixed interest bonds, and they provided also fixed interest loan. But in this case, again, the maturity was 50 years. So this is highly special. Okay, in the case of Greece, we see the saga starts in 2010 when people realized that they were falsifying all their reports for a decade, and also there were many nasty things were happening. So EU had to bail out not just the government but also the banking system. So all the beautiful package together. At the beginning, this amount of money was requested, but obviously it was not enough, so they needed some funds from the IMF. Then some additional million euros were provided again during the next years. And after that, ESM was already purchasing or inheriting 55% of the debt. So they are the major bondholders, and as you can see here, that the average maturity is already really low. So we can see that, okay, they got the money. This time again, you don't have to remember it. Just what you have to see that they had to repay it until 2016. So hopefully we will be retired at that time, or close to retirement. And also at the same time, people were really angry in Greece. So the government had to meet this requirement. So this was the austerity requirement. So they should have a budgetary surplus. Come on. They should have a VAT of 23%. Come on, guys, in Hungary this is the low VAT level. We have maybe 30% if you're adding everything together. Corporate income tax must be increased by 2%. Luxury taxes were increased. Now they have to be collected, so that was also a valid point in the contract. Also, defense expense had to be cut. Yeah. The retirement age was increased to 67 years, but also gradually. Anti-corruption measurements, wage cuts in public sector. This is my favorite. Autonomous tax authority and statistical office. So this is a requirement from a member state within the EU and also within the Eurozone. The pinnacle of institutional development. And also privatization of regional airports, harbors, electricity grid, obviously to grab some money altogether to finance themselves. So yeah. And after that, this is a detailed list here, but I don't want to spend some time. Okay, there was another funding issue, but for Cyprus and Ireland, the two money laundering machines of the EU, they needed just they are providing financial services for wealthy individuals abroad who can be acquiring their funds from illicit sources sometimes. But yeah. So washing machine needed some funding because they dived deeply into US toxic assets. And also the EU said that it's a really nice thing, but in this case, they are doing the bailout for the banks, but foreign depositors should cover also 25% of the losses. So this is one single case when depositors were not insulated from. But Cyprus was always a washing machine, so their banking system is a different thing. In case of Spain, this is not a washing machine. So in this case, they were hit hard by the real estate crisis. Then it was also killing their GDP and also affecting badly their banking system. So non-performing loan ratios were sometimes nearly at 20%. So it was absolutely terrible. So their public debt jumped from 40% of the GDP to 100% of the GDP within a year because they needed money to bail out banks to avoid total financial collapse. In this case, we can see that still the required money was not that much. Also, maturity is coming closer and closer. Wow. But they needed money twice, and after that, they started to consolidate. Portugal was similar case to the Spanish one. And Ireland, this is another washing machine. Just in this case, it's for Anglo-Saxon entities and UK. So we can see that after they bailed out some banks, it was completely okay-ish. And yes, GDP growth was the highest among EU countries in this year. Yes, because Apple moved their overseas funds to Ireland, and that's why GDP was increasing suddenly because of an accounting decision. So, okay, these are legal things, so I cannot call it money laundering because it's tax optimization and it's legal, but yeah, still somewhat disgusting because these tax revenues are missing from somewhere. Okay, so that's all. There is also a comparison table between IMF and the ESM, which is nice. And that's all for today. Next week we will focus on the World Bank and the BIS. Thank you very much for your attention, and see you next week.